Hello, good morning. It's Thursday the 21st. Just been praying for a good day in the markets. And this is the market brief. So we had inflation data out yesterday and the headline number fell slightly. CPI came out at 3.1%. That's down from 3.2% last month. But before the Bank of England could pop the bolly and toast their success, producer prices spoilt their party. That rose from 11.2 to 11.4%. And while the supply chain bottlenecks continue, it's unlikely that inflation will fall below the 3% level in the short term, especially if we are heading towards a fourth lockdown. But are we? This is the first real crisis that Health Minister Sajid Javid has faced since he took over from Matt Hancock in the summer. Current new daily cases are around the 40,000 mark, and he admitted they could reach 100,000 as another variant has been detected. However, he refused to change any of the regulations and even dismissed the idea of bringing back mandatory face masks on public transport. He has been accused of dithering over making any decisions, and the British Medical Association has even said the government is being willfully negligent by not reimposing restrictions. Punchy stuff. In the market, sterling continues to benefit from bets on an interest rate hike. We saw 138.35 against the dollar yesterday, but a bit of resistance may be forming around that level now. US GDP data for Q3 is out next week, and it's expected to fall back from the stellar levels seen in Q2. And as always, that will fuel the debate over the timing of the Fed's plan to taper support. But at the moment, they look likely to start tapering soon after the next meeting on November the 3rd. Businesses continue to report a shortage of skilled labour, though, which is affecting sales. That's alongside supply chain issues that are intensifying. Congestion at the ports are filtering down to wholesale shortages, which is in turn filtering down to Main Street. And there's no sign of that changing before year end. So what should the Fed do? If they begin to withdraw support, despite that being a long way from raising interest rates, it could send a signal that they're satisfied with the current situation. If they postpone, they may lose market confidence. So while it's becoming a bit of a cliche that the next FOMC meeting will be the most important for insert reason here, there is a lot riding on it. For now, though, the dollar remains in a corrective phase, with the market still unclear of the Fed's intentions. The dollar index fell to a low of 93.55 yesterday, and euro dollar opens around 116.40 this morning. Right, that's it from me. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.